So what should you do now? Stay informed, stay diversified, and don't let headlines make your money decisions. If you want to learn how to build a recession-proof portfolio, check out my next video. And don't forget to subscribe for weekly insights into finance, investing, and smart money habits. The July 9th tariff deadline is almost here, and the entire US economy is holding its breath. If these tariffs kick in, everything from groceries to gadgets could cost more, and your stock portfolio might not be safe either. So, what exactly is happening, and what should you do about it? In April 2025, the US government paused the rollout of sweeping new tariffs, essentially taxes on imported goods. This 90-day pause was meant to give room for negotiations. But now that pause ends on July 9th, and unless something changes fast, new tariffs of up to 70% will activate on August 1st. These tariffs are aimed at major trade partners, China, Mexico, and even the EU. The goal? Protect American industry. The result? Likely higher prices, slower trade, and potential inflation spikes. Financial analysts from firms like JP Morgan and UBS warn that if tariffs return, we could see a slowdown in corporate earnings, especially for companies relying on global supply chains. But others argue that the market has already priced in this risk. One thing is clear: July 9th is not just a policy date, it's a financial checkpoint. Financial analysts from firms like JP Morgan and UBS warn that if tariffs return, we could see a slowdown in corporate earnings, especially for companies relying on global supply chains. But others argue that the market has already priced in this risk. One thing is clear: July 9th is not just a policy date, it's a financial checkpoint. So far, the market is showing what experts call a wobble: minor dips, increased volatility, and investor hesitation. In fact, in the last 30 days, we've seen the S&P 500 fluctuate more than 6%, with sharp intraday reversals. Why? Because businesses are preparing for impact. Supply chains could slow, import costs could rise, and Wall Street hates uncertainty. Let's get personal. Tariffs might sound like a political issue, but they hit you directly. Expect the cost of everyday goods, phones, appliances, even food, to rise. Import taxes are passed on to consumers, and if inflation returns, your savings will lose value. For investors, it's just as serious. Your 401k, IRA, or brokerage account could see dips, especially in tech, manufacturing, and retail sectors that rely on global imports. But don't panic. Here are 4 smart money moves to protect yourself if the markets shake again. 1. Diversify beyond US stocks. Don't rely on one market. Add international ETFs or gold to balance the risk. 2. Build or refill your emergency fund. Rising costs mean your budget could get squeezed. A 3 to 6 month cash reserve gives peace of mind. 3. Don't panic sell. Resist the fear. Wealth is lost, not in downturns, but in poor decisions. Long-term investing wins. 4. Use dollar cost averaging. Invest fixed amounts regularly so you don't time the market. This strategy smooths out volatility.